the day I decided I have to go short NASDAQ was the day that I thought, like, when I heard that, I said, that's it. This is this, of course, what I didn't realize was that was just the tip of the iceberg. The US strategy is to control every choke point of the technology. In the rest of the world, if they want to use this technology, they'll have to rent it from American companies and pay them a lot of money, and that's the whole idea. That's how they're going to basically keep this technology out of China's hand.
Consumer sentiment has dropped the lowest level in months. Does this signal a spiraling of the economy that could get out of control? We'll find out with our next guest, David Woo, CEO and founder of David Woo Unbound. Now, David has had a very long career working in macro research and on the sell side of Wall Street. He holds a PhD in economics from Columbia University. He started his career at the International Monetary Fund, IMF, where he worked on the Asian and Russian financial crises. He later served as head of global foreign exchange strategy at Barclays, and then the head of global rates, FX, and emerging markets research at the Bank of America Merrill Lynch. So thank you for coming on the show, David. It's a pleasure to host you today. Welcome.
It's my pleasure.
It seems like Trump is backing off on a lot of the threats that he made on countries. He's readying tariff cuts. He is readying substantial tariff cuts, actually, designed to address high food prices and a series of new trade deals. The framework is aimed with Argentina, Guatemala, El Salvador, and of course, earlier in the month, you saw that a deal was struck with Xi Jinping. Why is he doing this?
I think it's pretty obvious why he's doing this, which is the fact that, the midterm election is now only less than a year away. And let me tell you this, I think there's not been a president in the last 50 years that has as overwhelming an incentive to help his party retain congressional majorities as Trump right now heading to this midterm. And that's because it's very simple. I mean, imagine if if Republicans were to lose either the Senate or the House. Trump is going to go from Trump the powerful to the Trump to be the lame duck. And in fact, the Democrats are going to unleash a major legal onslaught, that will bog him down for the rest of his administration, starting with an impeachment trial over his crypto dealings that have netted his family more than $5 billion. Now, the point here is that, so Trump needs to win the midterm. And I think coming off what happened last week, which was a major victory against the Democrats over the shutdown, I think Trump actually thinks he can. Because the odds, by the way, just so that you know, the odds are not good. Because in 20 out of the last 22, midterm elections, the president's party has lost seats in the House. So Trump will be doing almost the impossible. The only two exceptions, which is Bill Clinton and George W. Bush in 1998 and 2002, their approval rating were in the mid-60s. Trump's approval rating right now, as of this week, is at 42. So Trump will have a lot of work cut out for him. And of course, you say, well, what is he going to do? Let's think about this. If you look at his approval rating, where he scores the worst of anything is on inflation. Right now, his approval rating on his handling of inflation is at 35%. Now, so I think from that point of view, I want to assume that if for nothing else, Trump is going to do everything he can to drive down inflation over the next year. I mean, the next 6 months, just so that inflation starts to moderate into the actual election day. And that means, in my humble opinion, there are unlikely to be further actions on the trade war front. I think Trump is probably going to, in fact, anything, reverse some of the tariffs. He's going to look to basically drive down gasoline prices. And maybe for that reason, he's not going to go invade Venezuela. But whatever he's going to do, I think it's safe to assume that next year, at this time, inflation will be quite a bit lower than where it is now.
What do you think is his priority or main focus then? Is it actually inflation? Think about it. If he's so concerned about fighting inflation right now, I'm not sure if he is, but let's say he is, why would he keep pressuring the Fed to lower rates? I mean, he may be unpopular, but I don't think he's stupid. He would know that lowering rates would exacerbate the inflation problem.
I think, Trump, obviously, he's a political opportunist, and I think he's got excellent political instinct. And I think, at the end of the day, at this point of his presidency, he's quite different than a year ago when he first started. At this point, it's about the midterm. I really believe it's about the midterm. And I think from that point of view, you got to look at the opinion polls and say, well, what do I need to do to improve my approval rating? That's what it's going to come down to. Now, of course, the other part of it is going to be jobs. There's no doubt. And this is why I have absolutely no doubt that there will be more fiscal stimulus to come. In fact, I think, I think it's a great idea to do. Politically, it's a great idea to basically roll out this $2,000 basically tariff rebate. Okay. In fact, do it as soon as possible through the second reconciliation bill, which I think could be passed as early as the first quarter next year. Do that before the Supreme Court hands down the judgment over the constitutionality of his tariff. So to make it a fait accompli. So I think from that point of view, I think you're going to see that Trump's second year is going to be very different than his first year because Trump cannot even begin to imagine losing majorities in Congress, which will make his life miserable.
What does the Trump administration have to show for the midterms? In other words, what progress or advancements in the economy and or their foreign policy can they show the American people?
I think, again, it's actually very interesting because, part of it obviously is about perception versus the reality. Inflation is growing at 3%. But, if you look, and yet, as I said before, Trump's approval rating for handling inflation is at 35%. So clearly there's this perception that inflation is a bigger problem than what it actually is. Because, by the way, I don't believe that, the BLS is making up the numbers because we have a lot of private sources on inflation, like, Price Stat, for example, which is consistent with the idea that inflation is running around, 3%. So I think from that point of view, I think the Republicans have to tell a much better story about what they've accomplished. But I think they have to see tangible things. That is to say things like coffee prices, banana, which is they're talking about now rolling back big time in terms of the tariff. Things that touch the common guy, gasoline price. If they can drive it down by basically another 30 cents between now and the midterm, I think that will be acknowledged openly and widely by the voters. So I think they'll have to do something that is obvious, that can touch people and everybody in the street can actually relate to, which is not that easy. But that's why the $2,000, tariff rebate is a terrific idea because there is nothing that's going to be more obvious than everybody getting a check for $2,000 in the mail. As crazy as it may sound, and it's going to blow a big hole in the budget next year. And this is why I think, the curve is going to steepen next year, which is a different story and so on and so forth. But I think that Trump is going to go down this path. I have almost no doubt about it.
Before we continue with the video, let's talk about a growing issue, a very important issue, online privacy. Your personal data isn't just sitting in your email or phone. It's being scraped, sold, and passed around by data broker sites every single day, and you may not even know it. Today's sponsor, Delete Me, helps you fight back. They monitor hundreds of broker sites, scan for your exposed personal data, and remove it before it can be used against you. You'll also get regular privacy reports that show where your data was found and what's been taken down. In fact, in one recent check, they reviewed over 340 plus listings to see if any data broker had my personal information on my report. That's how much is out there, and they keep scanning every single week. Don't wait. Go to joindeleteme.com/DavidLin and use the code DavidLin for 20% off of all U.S. plans, or scan the QR code here on the screen right now. Take control of your privacy before somebody else does. Yeah, he is committed to the $2,000 dividend. Okay, I got a few questions about this. So from a political standpoint, why is this necessary? He's not up for re-election. He's got his second term already up, finishing up this term. So why does he really care? If let's say the midterms are favoring the Democrats or the Republicans, why does he have to blow the budget to buy votes, basically? It doesn't make sense.
There are a few reasons for this. First of all, in America, I think, the term lame duck usually applies to the second half of the second term of a presidency. Okay. In other words, that, once you get into the second half of your second term, your party knows that you're not going to be running for re-election. So you're irrelevant. So therefore, they stop paying attention to what you say. Okay. Now, obviously, because I was saying, once you lose, essentially your majority, essentially the legislative phase of your presidency is over. And as I said, on top of that, the Democrats are going to impeach him They're going to come after him, his family, everything he's done up to now. I'm telling you, he's going to have, he's made a lot of money in his presidency so far, $5 billion. So he's got plenty of money to basically hire some expensive lawyers. But believe me, this is what is going to be in store for him. So I think from that point of view, there are a lot of reasons why I think Trump probably does not. He will do anything. He will throw the kitchen sink at this midterm election to basically avoid, essentially losing the majority, essentially in both houses.
Consumer confidence is low, like I mentioned. Let me just pull up the survey of consumers from the Michigan Index, University of Michigan here. So here it is. And as you can see, it's been trending lower for quite some time now, basically ever since COVID, never really recovered. But it really, the trend really got worse throughout 2025. Why is it at a multi-year low right now? And second part of the question, do you think the $2,000 dividends, they want to call it dividends, not stimulus check, do you think the $2,000 dividends will help?
I think the point here is this. I think, personally, I think the reason why consumer confidence has been collapsing, okay, and by the way, just to put that in perspective, the magnitude of the decline in consumer confidence since the start of the year is what you see typically at the start of a recession, not at the start of a new presidency, by the way. So this is extremely unusual, what we've seen in terms of the magnitude of this decline, okay? Now, I personally think it has everything to do with the tariff, okay? And I think that the tariff actually has been a big problem for the US economy. Now, of course, we all know it hasn't really shown up much, I think, in the inflation data. Again, CPI is running at 3%. It's not 5%, 3%. But I do think that the fact that inflation is low, meaning that the pass-through from tariff into inflation has been limited until now, is because companies don't have pricing power. They haven't got pricing power because actually consumer sentiment is actually very weak. Companies know if they start raising prices, they won't be able to sell anything. So I think from now, and then the fact that, consumption was reasonably healthy in the second quarter was mainly because of preemptive buying, I would argue, in anticipation of higher prices ahead. And this is why I do think that, holiday shopping season in the next 4 weeks, I think is going to be key, but I think it's going to be very weak for the most part. Now, what is even worse is this. Because companies haven't been able to pass on the higher tariff onto consumers, guess what? They've seen pressure on the operating margin. And this has forced them to basically find ways to cut costs. And guess what? They've been laying off workers. It's actually very interesting because literally the White House has a spreadsheet where they track every single companies in terms of whether they're raising prices or not. Trump said this, actually. He said, American companies better eat the tariff or you're really going to be in trouble. So right now, companies cannot raise prices. So what are they going to do? They're now basically finding AI as an excuse to lay workers off. And that is what's really going on. So what is really going on is that, so we're having to see higher inflation. That's because, we're seeing basically more layoffs. I mean, as you probably know, announced layoffs this year to date is about almost, 1 million people, which is, again, which is the highest since COVID. So all in all, I think this is the problem. The problem with consumer confidence is the fact that people are wary about the labor market. People are feeling very insecure about their jobs. People know that if you lose your jobs now, you're never going to find another job, at least not with the same pay. Right now, I know a lot of people in that situation right now. And then they can see that prices are going up. And I do believe many Americans are worried about the AI bubble. I think it's very clear. This is why, like my own survey shows that there is tremendous insecurity about the financial situation of Americans right now.
I want to touch on the AI bubble in just a minute, but going back to the labor market, what has contributed to this labor market? In other words, suppose Trump were not in office, maybe he were, but let's just take the tariffs out of the equation. Suppose tariffs never happened, will we still have a weak labor market?
I think, listen, I think, we will have a weak-ish, but I don't think quite as weak as what we're seeing right now. But there is no doubt. I think, again, if you look at, it's actually, to me, the most interesting thing is like in manufacturing, right? You would think that Trump's tariff is designed to make American goods more competitive by lowering the relative prices of US produced goods. And therefore, you would think that the import substitution, import competing sectors should be really like benefiting. They should be actually on fire right now. Import competing sector, of course, is the manufacturing. And yet, if you look at autos, you look like furniture, which are the two biggest manufacturing sector in the US with, capacity right now. I mean, both sectors continue to basically shed workers like there's no tomorrow. So I think what it's basically telling you is that, globalization has also globalized supply chain. So even those that are supposed to win out, benefit from just tariffs, are caught up in a very difficult situation. Let's look at GM. GM's operating margin a year ago was at 7.2%. Now, this latest quarter was 2.2%. That's a drop of 5 percentage points thanks to tariff. And so I can understand why they're laying off workers. That's what it is.
Let me show you this headline. This is quite interesting here. The U.S. is supposedly losing thousands of manufacturing jobs, says analysis. This was reported by CBS early in October. Employers shed 12,000 manufacturing jobs in August, while payrolls in the sector have shrunk by 42,000 since April, according to new analysis from the Center of American Progress. Isn't it ironic that this is happening when the whole purpose of tariffs is advertised to bring jobs back to America, to onshore manufacturing?
Exactly. By the way, out of these 12,000 manufacturing jobs that were lost in August, 10,000 of these jobs were basically lost in the auto industry and the furniture industry. And which is interesting because, we're not talking about, like, you think about this, right? You say, well, there's some industries that U.S. already got out of 20 years ago. So like, a change in relative prices, tariff, over 6 months, not going to make a difference. But if you look at autos and furniture, these are two industries that were going strong at a certain point until a few years ago. And there's a lot of spare capacity in both sectors. You would think that these two sectors, at least we should be seeing, hiring going up. And the fact that we're seeing the opposite, in fact, that they're leading actually the firing, that to me is fascinating.
So which sectors are the strongest right now from an investment perspective?
Listen, we can sit here and talk about this, but obviously tech has done well. For whatever that means. To the extent that the contribution from capex of in terms of spending on information equipment is currently whatever. It's like what, 2 percentage point of GDP. If it hadn't been for the capex, basically spending by tech, the U.S. economy would have gone into a recession already this year. So I think the important thing is to say, for me, in my humble opinion, if it hadn't been for AI, the U.S. economy would have probably already gone into a recession because of the tariff. And the reason why it didn't is because of AI, and AI mainly because a combination of the capex spending, which has contributed importantly to GDP growth, but also because, but even more important is, of course, the wealth effect associated with the $14 trillion of wealth that was created since April alone. That has definitely, enriched, put a lot of money in people's pocket, and they go on and spend it, at least, the rich people. So I think from that point of view, to me, it's interesting because Trump got very lucky. I would say he got, again, sometimes, it's better, it's better to be right. It's better to be lucky than right, by the way, as we all know. I think his tariff war would have pushed the U.S. economy into a recession, but he got lucky because the AI bubble just went, essentially exponential. And I think from that point of view, I think therefore the biggest question, I think going to 2026 is when is the AI bubble going to burst? Is it going to be now? Because if NASDAQ goes down 20% or more, which is my forecast, the U.S. will go into a recession and Trump is just going to basically kiss his whatever, the midterm goodnight and goodbye.
20% or more this year? By the end of the year or like next year?
I'd like to see that because I'm actually short NASDAQ myself. I've been short NASDAQ for the last couple of months. It's been very painful, but now I'm back to as of yesterday, I'm back to even. But the point here is that I don't know. I can tell you it's for sure going to be basically this year. But I think, certainly I think over the next 3 months, I think there's a very good chance that I think NASDAQ will be heading much lower.
I want to get your reasoning, but just take a look at this chart. You said you've been short the NASDAQ the last couple of months. Something must have triggered you to say this is getting way too expensive. At what point did that start to look that way, David?
I'll tell you, the day I decided I have to go short NASDAQ was the day that Larry Ellison became the second richest man in the world because Oracle stock went up like 60% on the back of an announcement by OpenAI that this company that is on track to make $12 billion this year is going to spend $300 billion on, whatever computing services from Oracle in the next few years.
Yeah.
That I thought, like, when I heard that, I said, that's it. Of course, what I didn't realize was that was just the tip of the iceberg. That Sam Altman, in his quest to cash in on this AI thing, because, as he's now finally got his for-profit company spun off from the, nonprofit, and they're basically lining up for a potential IPO that can make him very rich because they're talking about $1 trillion. That I didn't realize that his game plan of pushing for an IPO with a valuation of $1 trillion or more when he's only making, when he's losing $20 billion is by announcing a partnership with everybody in the universe and promising to spend money that he hasn't got. But the market bought into it, whether it was Oracle and then was NVIDIA and then Broadcom, A&D, you name it. So I think, but the Oracle case obviously was when I, first realized what was going on. And by the way, if you look at the last 2 months, the rally, the NASDAQ rally of the last 2 months has not been about, Microsoft or whatever for Amazon. It's been about OpenAI. OpenAI's quest to become a hyperscaler, to become a competitor to his biggest customer, which is Microsoft. I mean, which is like, if you think about that alone is not that, it's quite bearish, I think, for the whole AI thing. But be that as it may, I think the market's starting to get the joke.
The fundamentals make sense of what you're talking about, but here's the kicker. We've got liquidity coming. QT is ending in a matter of weeks now. It's already mid-November. And some say that is stealth QE, although it's not really. But certainly we'll have more liquidity, not less. The Fed is still cutting rates, although it's dubious whether or not they'll be cutting as much as expected, given that inflation is higher. But in either case, we're in a dovish mode right now. That's good for risk assets, right? Are you factoring that in? I'm
factoring that in. In fact, actually, and it's very, very interesting. 2 weeks ago, as you know, Jerome Powell, during, the press conference of the last FOMC meeting, pushed back on expectation of a December cut. I wish I could sit here and tell you that why I saw that coming. I didn't. But in my view, it was very clear why he said what he did. Because I think the Fed is as worried about the AI valuation as I am. Except the Fed cannot come out and say, oh, wow, this is a bubble. Except I think that the Fed has decided they don't want to become an accomplice of this bubble. And therefore, the last thing they want to do is to blow more air into this bubble. And I think from that point of view, that is the reason why, I think this is why, in a way, the stock market and the rates market, the correlation has become quite positive. So, well, stock market goes up, then the Fed is less likely to cut, and then rates going to go up. And stock market goes down, that's a different story. But what I'm saying to you is that I think the Fed gets the joke. I think they must be very worried because, we've seen this movie before when many people argue back then, Greenspan should have stopped the dot-com bubble. I mean, when it burst finally, it was, it was terrible. And then, that Bernanke should have stopped the housing bubble. When that bubble burst, the U.S. economy went into a protracted recession. So I think from that point of view, again, the Fed will never admit it, but in my hunch is that they actually are concerned. And so from that point of view, if NASDAQ keeps going up, then I think, you're probably not going to see the sort of interest rate cuts that we might get, in normal circumstances.
Now, this is a very interesting perspective from the Wall Street Journal here. Who is paying for the AI revolution? Okay, so tech companies are facing an enormous investment need that will outstrip even their considerable existing resources. Morgan Stanley estimates that roughly $3 trillion that is expected in global data center capital expenditures through 2028, only about half of that could be funded by projected cash flows. So that leaves about $1.5 trillion of financing gap. So where are they getting that money from? According to this article, to meet such a tremendous need, the companies will need to turn to the biggest funding markets. When it comes to corporate borrowing, those include mainstream high-grade bond markets. Issuance in the investment-grade corporate bond market presented about 2/3 of the more than $2 trillion sold this year. And who is, invested in the mainstream bond markets? Well, retirees and pension funds. A lot of those. So that's, I'll let you comment on what I just read.
I think, I'm not that worried about like where that money's going to come from, because I think we're going to see this thing crash way before we get to that point. Because at the end of the day, right now, the issue I think the market's starting to understand is not how much can CapEx be ramped up. Right now, the issue is when are we going to start seeing returns? Because the problem right now, the biggest problem right now, is the inability of the entire tech industry to monetize on AI. Now, and there's a very good reason for this. It's actually, I'm sure you would have talked about then, I think this is an important report. A couple of months ago, MIT came out with a report based on hundreds of surveys in which they show that only 5% of US companies have decided to put AI into production. Okay. In other words, only a 5% US company, AI is making a positive P&L contribution. The other 95%, when they interview the CTO, they say, well, listen, the technology is not ready for prime time. Now, it's interesting because I don't have to tell you, ChatGPT 5.0 came out 3 months ago. It's generally considered to be about 20% better than ChatGPT 4.0. And yet it took them 3 years to launch 5.0. Now, if the technology is not good enough, and then it will take them 23 years to improve the technology by 20%, they've got a problem. They really have a problem, because at this point, the depreciation rate, this is not like fiber optic lines that were laid in the late 90s that had a life expectancy of 30 years. You're talking about these chips that depreciate, basically losing all its value in 3 years' time. So unless Sam Altman is right that all of a sudden we're looking at artificial general intelligence, AGI is going to take over in 3 years' time, I think this whole AI revenue story is going to come back to basically haunt the whole entire AI bubble sooner than you think.
So now that we have the government shutdown over, essentially, we now have government data to analyze going forward. So back to normal on that front. What government data or pieces of data are you looking forward to the most that you think may trigger the sell-off that you're warning about?
I think, listen, obviously, I think the job data is going to be the key thing. It based on, but again, we have a lot of, like ADP now, they release weekly data and so on and so forth, and that tracks basically BLS data fairly, reliably, and that suggests that, things have actually picked up a bit. Okay. Yeah. So from that point of view, I think the point here is, ironically, we're now at a point, okay, that bad news is good news. To the extent that if the data really come in really bad, then the Fed will be forced to cut rates, and that could give you the kind of liquidity-driven rally that you're looking for. But I think but then you need really bad data, and by the way, we now know basically the October data doesn't look like it's going to be released because they don't have them. Okay, so basically you now have to wait until December to get the November data. Okay. And then once you get the November data, you don't even know to what extent that, because you haven't got a context to really interpret it, because if you haven't got the October data, you don't know to what extent the November data was basically because what happened during the shutdown, which is now over. So from that point of view, in a way, even though the data blackout has ended, theoretically, it actually hasn't ended. And for economists, in terms of being able to read the data in order to basically make policies based on data, I would say that we're still probably at least 6 weeks, if not 8 weeks away.
Okay. What about Chinese tech firms? I think AI is maybe a mega trend that we can't ignore. Maybe American tech firms aren't there yet, and maybe their valuations are a bit too lofty. But is China catching up?
Yeah, I think this is a key question, right? Because I mean, if you think about the AI bubble as being the biggest macro story in town, right? And I said, I think the AI bubble faces two major risks. One of which is, of course, as I said, the inability to monetize. So if revenue does not really start to accelerate at 200, 300% for OpenAI, I think people are going to start to basically pull back. That's obvious. The other risk that I think the whole entire AI bubble is facing is, of course, China. Okay. I mean, let me tell you this. Both China and the US understand that the AI battle is going to be decisive in terms of determining the outcome of this race for economic hegemony. The US and China have very, very different strategies. In fact, actually opposite strategies. The US strategy is to control every choke point of the technology, from chip design to large language models to hyperscalers, and Trump wants to revive Intel so they can control chip manufacturing as well. And the idea is that America would dominate technology completely, and the rest of the world, if they want to use this technology, they'll have to rent it from American companies and pay them a lot of money. And that's the whole idea. That's how they're going to basically keep this technology out of China's hand. So that's the US basically line of attack. So what is China's basically line of attack? China's whole entire strategy is designed around turning AI into one big commodity, zero price commodity. Okay. This is the reason why, all the Chinese large language models are open source. I mean, then right now of the six best, whatever large language models, 3 of them are Chinese, okay? And they all open source. On top of that, there are at least 20 Chinese chip companies that are working towards producing AI chips that will cost a fraction of NVIDIA's chips, okay? Because what China's decided, if they want, obviously philosophically, they're saying, well, AI should be accessible to everybody. So they want to basically make it as cheap as possible. And the Chinese are very good at making things cheap. So as a result, what they want to do is drive the price of AI to zero. Of course, they think with that, they'll be able to essentially stop the US stranglehold on technology and bankrupt the US, by the way. Because if they did that, because if you think about so you have two different strategies going on. Right now, it's interesting because if you look at the high valuation of NASDAQ, the market clearly is currently pricing a US victory. Yet I can tell you, the Chinese are getting closer and closer and closer every single day. In fact, actually, just this morning, Baidu just announced that they're going to be they're going to be basically releasing 2 AI, essentially inference chips already next year. And as I said, there are 20 basic chip designers in China. Listen, this is the story. The story, what people need to understand, this is the biggest story in town, which is that, a few years ago, under the Biden administration, the US created the whole entity list as a way to sanction, Chinese companies to basically restrict their access to sensitive technologies. Now, Eric Schmidt, the former CEO of Google, was the architect behind this entire program. And Eric Schmidt used to basically brag about the fact that this program is designed to give the US a 2 to 3 year lead over China. And he used to say the 2 to 3 year lead is like eternity because technology is constantly changing. 2 to 3 years is it's a huge advantage. Let me tell you this. The most important thing that's happened in 2025 so far, and the most fundamental realization that's dawning on Washington, okay, is that it's no longer 2 to 3 years. It's now more like 6 months. Why do you think that Microsoft and Amazon came out yesterday and said they don't want NVIDIA to be selling chips into China? I'm telling you, this is the problem. So from that point of view, I think that China is catching up rapidly. And by the way, we're not talking about just basically large language model. In terms of, I have to say, I'm rather surprised myself. I did not predict this. I didn't think this was going to be possible. How they managed to do this, I have no idea. But Chinese companies, in terms of building semiconductors, is complex business. There are a lot of machines involved. The Chinese are now making their own etching machines, their printing machine, their lithography machine. It's just incredible what they're doing. So I think from that point of view, this is going to be another major risk I think facing the US AI bubble. And then, and this is going to be, and this is very scary for the US because it's possible right now the US, the Microsoft, the hyperscalers are investing hundreds of billions of dollars in a technology that's not ready for prime time. And then if that will almost certainly guarantee a US defeat, and this is not even going to be, it's not even funny. I mean, I think, in terms of like, I mean, I'm an American, I want to see the US at least have a fighting chance, but this is going to be potentially the biggest risk for the US dollar, for the US stock market, for the US economy, period.
Right, but Americans still don't have access to Chinese stocks unless they invest in the Hang Seng or something, right? So, it's not like it's an alternative that's readily available for most people.
Yeah, but you can buy Chinese stocks now, like, most, just like in the US, most of these big companies like Alibaba, Baidu, all that, I mean, they have ADR.
Big ones, yeah, the big ones.
Yeah, but the point here is this. I mean, ironically, this is not even about investing in these stocks, because the honest truth is that Beijing does not care about profits. This is not about profit. Xi Jinping does not care, about profitability. Okay. He just wants to win this race, of economic hegemony. He also needs to win because if he doesn't, the US is going to do everything to keep China back. So from that point of view, this is why, like in the past, whenever like there's an economic slowdown in China, they'll be like pouring hundreds of billions of dollars into stimulating the economy through real estate. You're not seeing them doing that because all the money they've got right now is being spent on R&D, on essentially pouring money into companies so to basically play this catch up, because they realize if they don't basically manage to break this basically the stranglehold that the US has over China's basic access to technology, China's dead duck. So from that point of view, I think, there's no doubt in my mind that China is in a desperate drive to play catch up. And so far, I have to say, the results have been very impressive.
Final question then, David. What do we as investors have to do to play catch up with this growth? In other words, where do we position ourselves? You're short the NASDAQ, so we understand your position. Then if we have to be long something, what do we do?
Listen, I'll tell you, like I like different things. There are different ways to basically play this. And I like India, actually, by the way. I like India because, I think, first of all, let's remember, India is the worst performing stock market in 2025 so far, despite the fact India is actually the fastest growing economy. It's ironic, but it is absolutely true. I mean, there are a lot of reasons for this and so on and so forth. Part of it, but there is no doubt, the way I look at this is that this technology race between the US and China is going to get more and more intense over the next year and 2 years. I mean, to the extent it could get very ugly, okay? And there is no doubt the biggest beneficiary of this entire, this clash of civilization between the US and China is going to be India. Because there is no doubt, I mean, just think about that for a moment. iPhone 17 just came out. It's getting rave reviews. It's the first time that any iPhone is being made outside China. It's in India. This should basically shut up anybody who was skeptical that India was going to be able to actually produce at the same quality as China. This is going to invite a lot of money. And then you just think about this, India. I mean, half of the Silicon Valley companies, the employees are Indians. I think from that point of view, if there's one economy that I think is going to be able to avail itself of AI and so on and so forth, and then with the geopolitical repositioning in the world, I think India is actually, looks to me, to be a winner in 2026.
Okay, thank you very much. David, where can we follow you?
I've got a YouTube channel, David Woo Unbound. If you're interested in my investment strategy, come check us out at davidwoounbound.com.
We'll put the links down below. I'm just curious before we go, why you decided to leave Wall Street to start your own business. I'm always curious to understand why people do the things that they do, that they've done.
I think mine was been, listen, I mean, in 2020, which was my last year on Wall Street, my team, I managed 50 analysts, the biggest macro strategy team on Wall Street. And in that year, we won something like 17 number one ranked positions in the Institutional Investor Survey, which was more than all other banks combined. And I said to myself at that point, like, I cannot do better than this. And I decided to essentially retire. So I actually retired. Okay. And I guess I'm old enough that I was part of the generation that could still retire in the early 50s from Wall Street. And then my wife is from Israel, and we've been together for many years. And I've always promised her that I was going to move to Israel. So these days, I'm running my own advisory business. I'm a professor here in Israel as well. I tend my garden, and I'm having a great time talking to people like you.
Okay, well, this sounds like a good life. Congratulations. Well, we'll put the links down below. Follow David there. We'll speak to David again. Thank you. Speak next time.
Thank you. Thanks for having me.
Thank you for watching. Don't forget to like and subscribe.